Welcome to McGraw-Hill Financial's May Loan Market Overview Clip. I'm Steve Miller, a member of McGraw-Hill's Leveraged Commentary and Data team. This month, we'll discuss how the market staged a comeback in April after stumbling in March. For real-time updates on the loan market, please follow LCD on Twitter, Facebook, and LinkedIn. As well, you can download this presentation on slideshare.net. Before we start, here's our standard disclaimer. In April, the loan market shook off March's shallow setback. Like the equity markets, leveraged finance recovered as fears emanating from the Middle East and Japan faded and investors refocused on stronger corporate performance and declining default rates. Confidence restored, loan returns pushed back into the black in April after falling a skinny 1 basis point in March. As well, leadership shifted back to lower priced, lesser rated credits. In general, clearing levels in the new issue market narrowed by about a quarter point in April after pushing higher by 50 to 75 basis points in March. That leaves new issue prints roughly midway between the lows of February and the recent highs. Looking ahead, the trend appears to be issuer-friendly, at least in the near term. The reason, clearly, is the ongoing imbalance between demand and supply. In April, inflows into mutual funds and bond takeouts continued to run ahead of new issue supply. The tide may turn in the late spring, however, as the full boat of acquisition-related loans on the calendar starts to filter into the market. Defaults have been scarce over the past 12 months, pushing the default rate to a 38-month low of just inside 1%. That's a rapid retreat from the November 2009 peak of 10.8%. This chart explains why market technical conditions started 2011 in a ball of fire, calmed in March, but remain strong today. The black bar shows the growth in overall institutional loans outstanding in the S&P LSTA index. Aside from March, the market has been consistently contracting for the better part of 2 years now. The other bar shows inflows into the loan mutual funds and CLO issuance, mostly on the strength of retail inflows, which total about $19 billion over the first 4 months of 2011, according to Lipper FMI, by far a record sum. Demand has far outstripped supply. Looking ahead, a surge of M&A loans in the offing may help balance the scales in the month ahead, as we'll explore later in this presentation. Switching gears to market fundamentals, the picture is brightened further. April, in fact, was the second month in a row without a default, the longest such stretch since 2007. In response, the default rate by principal amount fell to a 38-month low of just under 1% and now sits far inside the historical average of 3.7%. Most managers are optimistic about the outlook in the near term. For one thing, issuers have worked down much of the maturity wall for the next 2 years. For another, corporate earnings continue to expand. As well, strong liquidity has allowed even struggling companies to refinance and extend maturities for 3 to 5 years into the future. With technicals and fundamentals running positive, loan prices recovered in April after wobbling in March. As of this writing, LCD's flow name composite stood at just above 98 cents on the dollar, up from a year-to-date low of 96.6 in mid-March. In the new issue market, meanwhile, average new issue clearing yields were little changed in recent months. Beneath the surface, however, the type of deals that were able to clear shifted significantly. During the red-hot months of January and February, issuers were executing repricings and covenant-light loans at levels not seen since the early 2007 heyday. Then in late February and early March, managers turned their backs on most of these issuer-friendly structures as fear eclipsed greed. In April, then, issuers regained the upper hand, reviving both repricings and covenant lights at a slightly lower pace than we saw early in the year. Looking ahead, the big thematic change in market tone will spring from what's depicted here, a welcome increase in M&A-related loan volume. Participants expect these fresh deals to soak up some of the excess liquidity that has built up over the past 12 months and help balance supply and demand in the months ahead. To wrap up, some themes to watch in the months ahead. First, the sudden pickup in LBO and M&A financing should help even out technical conditions after long running in an issuer-friendly direction. Most managers, however, expect inflows into loan funds to continue apace as investors look for a way to hedge rates without completely forsaking yield. As a result, we probably won't see technicals shift back much in favor of investors unless we see a pullback by retail mutual fund investors. April brought an encouraging new CLO from Credit Suisse Asset Management, a $410 million vehicle called Madison Park. The deal printed its senior liabilities at a post-credit crunch low of LIBOR plus 130 on a discounted basis. That is well inside the 175 to 200 basis point range of late 2010 and into the early part of this year. What's more, the deal was structured with nearly 10 turns of leverage, up from the 7 to 8 times standard of prior executions. These more equity-friendly levels may spur a mini revival for CLO product in the months ahead. Further down the road, however, managers worry that the skin-in-the-game regulations that are being implemented now in Washington will slam the door on issuance when they are scheduled to take effect in 2013. Finally, as mentioned before, credit fundamentals continue to improve and provide a strong underpinning for investor demand. That brings us to the end of our overview. For more information on the loan market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links for each is in the description of this video. As mentioned, you can also download this presentation at slideshare.net.